Cool. I think we can start now, and then as people they can sort of listen from there. Also, I think recording space will be recording this conversation, so they can access that later as well.
Excellent.
So, guys, it brings me great pleasure to have Rajesh here for my first Twitter space on startup investing. Uh, Rajesh is someone that I recently met in Pune, and ever since then I've been looking at his profile, and I leave more and more impressed. Um, he's been a startup investor slash angel investor for more than 20 years. He has worked in the private equity space at Franklin Templeton as senior executive head, private equity for Asia, Middle East, and Africa. He closely worked with Dr. Mark Mobius, who I'm sure a lot of you guys know. Rajesh was also on the board of directors for Globus Spirits and is now a current board member at Apar Industries. He's a member of the board at TIE Mumbai and is currently managing partner at Equanimity Investments. Equanimity raised their first fund with a target of 100 crores and exceeded the that amount by an additional 25 crores, totaling to 125 crores. His current fund is um, aiming to raise 350 crores with a green shoe option for another 350 crores, focusing on mobility, electrical vehicles, artificial intelligence, and blockchain. So, super exciting stuff. Really glad that we have Rajesh here today. Um, yeah, I also one more thing. An interesting piece of trivia. Rajesh is also the advisor to Marcellus's Little Champs. Something actually our audience members pointed out. Um, so yeah, we'll ask him a little bit about that along the way as well. So happy to have you, Rajesh.
Hi, I think the pleasure is all mine. Yeah, very happy to be here and share thoughts and hear some opinions from everybody here.
Great. So to begin, let's start with your beginning. You did your bachelor's degree in physics, and then pivoted to finance. What caused you to make that shift?
Well, that's a very interesting question. So I think my first love remains physics. As I grew up, I was very enthralled by the subject, and all the ways that physics tries to explain everything around us. And even now, in my spare time, when I'm not focusing on investments and companies and balance sheets and annual reports, I do a lot of reading about the recent happenings in the world of physics. Uh, the switch to finance was actually more of my surroundings. So as I was in college and growing up, I think uh, those were the years when Harshad Mehta was rocking the stock markets, and no matter who you were, what you were doing, you were very influenced as a young teenager in those years. So that was my introduction to finance, and I think I pursued that out of interest. And the best part of the entire thing was that physics has so many linkages with finance. So it's not as if they are two different worlds. There are very deep linkages between the two subjects.
That's fascinating. Is there any linkage do you want to share with us before we move on?
So I think, I mean, a simple thing is, a lot of us in the world of finance look at stock markets, and within stock markets there is the whole. Ask you to hold on. Can I put you
Raj,
on hold for just a couple of seconds?
Rajesh, you're on mute.
Yeah, yeah. Can you hear me now?
Yeah, please go
Right.
ahead.
Now I was saying, so there are multiple linkages between the world of finance and physics and mathematics, and of course stock markets. When you put them together, there are actually, if you just do a simple Google, there are many books that have been written on the linkages between these two subjects.
Okay, so let's move a few years into your career. You had the opportunity to work with and to be mentored by Mark Mobius while working at Franklin Templeton. How did that shape you as an investor and your view of the investing world?
Uh, I think Dr. Mobius has been a huge influence on my way of investing and my way of selecting companies and interacting with companies. Obviously, when you start investing, personally, or start investing as a fund manager, and you have such a large influence of such a huge personality like him, there is obviously there'll be rub-offs. And I think some of the basic tenets of investing, which are actually very basic, so there's nothing earth shattering that I would have learned from him, but something very basic like discipline. We all know that it is important. We all keep talking about it. You pick up any book on investing, it will talk about be a disciplined investor, etc. But I think when I worked with him, you really got to see firsthand, very close, from very close quarters, as to what really that discipline means. And once you understood what discipline means, the second thing was, how do you get to be disciplined? What does it take to be disciplined? What does it mean, first of all? And I think all of that I learned as I worked with him. And I think it's the best part of someone like him. When you have a mentor like him, is that people like him are very transparent, they are very open, and they are very happy if you learn from them. So it was a very exciting experience when I joined him in 1999, and worked with him for the next 18 years after that.
Amazing. I think it all comes back down to those basics that you refine again and again over the years. While at Franklin, you also began to hold board seats at publicly listed companies. Uh, what was that process like? What did you learn from it? And in your opinion, what makes a good board member?
Yeah, I think this is a tough one. We can do a whole 1 hour, 2 hour session on this. But I think let me keep it, very concise and simple. So I think the way you invest, and the way at least I invest, is getting involved with companies. So I'm a very active investor. When I invest in a company, I like to be very close with the company management, understand what they're doing, and in my own way try to influence or nudge them in the right way, at least the right way according to me. And I think, therefore, having a board seat on a company where you have significant exposure, both in terms of capital and in terms of interest, I think is very important. We all really, at least in the Indian ecosystem, and I think quite a few other countries as well, board members really don't do justice to the board seat. How the whole ecosystem works. But I think if one has the opportunity to get onto the boards of companies, or even the board of a single company, it's a huge opportunity, and we should make the most of it. The simple way that you can add value to a company and its growth and its long term trajectory is by at least basically asking the right questions. And I've been fortunate to be part of a few boards. You mentioned some of the companies, and quite a few other companies where we were significant shareholders. We would not have a formal board seat, but I would completely be involved, in all matters that typically a board would address. So I think it's a huge responsibility. It is not. There was a time, let's say till about 10 years back, when having a board seat was essentially, a status symbol that I'm on the board of this company, or I'm like, close to the promoters of that company. But I think that time is gone, and therefore, when we are on the board of any company, it's actually a very huge responsibility. That's how I see it.
Absolutely. You've been now in the private markets for more than 20 years. So, and you've invested both at the fund, and in your personal capacity. So, what are the top three things that you look at in a company before investing?
So I think so. It depends on the stage of the company that you're investing in, and having worn different hats, I can attest that the way the criteria that we look for in a listed company is very different than the criteria that you would look for in an unlisted company. But essentially, the basic fundamentals still remain the same. You are essentially looking to back or to be invested with the right set of people, and therefore, a lot of focus on management quality, whether it's listed company or unlisted. At Equanimity, when we invest in early stage companies, in fact, it's far more aligned towards the founders and the people who are running the business, because really you don't have 3 5 year balance sheets, annual reports available. You don't have quarterly conference calls, transcripts available that you can really do research on. So it's largely about the quality of people you're really backing. So I think that remains the primary source of comfort and confidence that an investor can get before investing in any company, which is the quality of management that you're backing. And I think once that is sorted, you will realize, if you look at the 4,000, 5,000 listed companies, the universe where you will derive a lot of comfort from the quality of management is actually very small. uh, and then within those companies, I think the second thing you got to look for, and I'm specifically talking about India, you have to look for those kind of companies which are in the throes of a growth trajectory, a growth path. India remains a growth market, and therefore there's a lot of companies, a lot of businesses, a lot of opportunities for growth. And I think as an investor, you have to align yourself with those kind of people who can deliver growth in whatever business they're running. So these are the two, I think, basic criteria one would use. And if you were to overlay a third one, is it simply look at sectors that you as an investor really understand. And we really don't have to have investments in every sector. Diversification or diversifying your portfolio really doesn't mean that. So you have to have exposure to a few sectors, but we should avoid businesses and sectors that we don't understand. So if, for example, I have done a lot of work on financials or pharmaceuticals, that kind of sector. My portfolio should have a lot of tilt towards those sectors. So I think these would be the 2 3 important parameters I would recommend everyone to focus on when you're investing, whether it's a listed company or unlisted.
I think really really great points there, especially the one around tailwinds, and that leads perfectly into my next question. So your new fund focuses on mobility, electrical vehicles, artificial intelligence, and blockchain. Why these four sectors?
Why not? See, I'll tell you, what we are doing with our second fund is that we are focusing on, like I just answered the previous question, we are focusing on growth areas. Uh, so, the basic sectors in India, which include healthcare or financial services, and if you were to include technology in that, fintech, health tech, ed tech, which is education technology, I think these are very primary sectors. There is enough and more opportunity in these sectors. But I think when you're trying to put together a fund and a portfolio, you have to have a core portfolio which will belong to these sectors, which will have companies belonging to these sectors. But you also have to have some kind of a satellite portfolio of some exposure to upcoming areas. And I think it serves two purposes. One is that if as investors we back upcoming areas, I think the potential upside can be really huge. And second is, if people like us who are managing money on behalf of others, if we don't incentivize and back new entrepreneurs who are trying to do different new stuff, then who will, right? So I think it's a dual responsibility, dual role that we play when we say that we are focusing on these up and coming new areas.
Great. When you look at blockchain in specific, how do you see its disruptive potential, and in your opinion, what kind of applications of blockchain have the most business potential?
Now this is a lot of let's say crystal ball gazing, because it is a new technology. Blockchain is a very new technology. There is lot of talk about how blockchain can help change things. How can blockchain be used in so many businesses and business processes? But I can assure you, this is still just talk. I think there's a long way to go before businesses, real world businesses, large scaled up businesses, start using blockchain technology as core to their operations. And unfortunately, and this is how the technology world works, by the way. So, unfortunately, newer technologies like blockchain will find it very difficult and to be adopted by large organizations. And remember that large organizations are the ones who have budgets to fund new technologies, or to fund any kind of technology. And so, therefore, whenever any new technology has come, it has always taken a long time to be globally adopted widely. Blockchain is no different. I think it's been around for a few years now. In my opinion, it is going to take another at least 5 years. I hear very various estimates on this, but if I were to take a very realistic assessment of the situation, in my opinion, it is at least 3 to 5 years away when you see larger organizations adopting blockchain as their basic technology. In terms of applications, Krishna, the good news here is it is such a basic technology that you can take a blockchain and you can apply it to any vertical. It can be used in healthcare. It can be used in, of course, the world of finance, banking, markets, etc. It can be used in logistics. A lot of companies, early companies who are using blockchain are using it there. Crypto is a great example of how blockchain can be used. So I think the applications of blockchain will be multiple. There are so many opportunities. At this point in time, I think because the technology itself is not so widely adopted, it's a bit early to really uh, lay bets on some sectors which may actually be leaders in terms of this adoption. So what we are doing, and that's what we've been recommending, is that we should all equip ourselves with our understanding of blockchain and its implications and disruptions that it can cause across sectors. And therefore, if you are really up to speed with the technology, you will not miss the curve when the curve starts rising.
I think that's a really great lesson for the investors out there. Staying up to date with the tech will also mean staying up to date with the level of implementation that we can currently see. So I think great pointer there. Moving on a little bit more to artificial intelligence. Artificial intelligence is a great umbrella term. But again, within the artificial intelligence space, is there something specific that you're looking for, or again, trying to keep up with the technology and spotting opportunities where they arise?
I think artificial intelligence is a little bit ahead of where blockchain today is. I think artificial intelligence has had at least a couple of years lead as a technology over blockchain. Of course, they're two very different technologies used very, very differently. Uh, and I think AI has applications again across any sector or any business process which has been computerized, which essentially in today's world means more or less everything. The challenge with AI is that in concept, it is very easy to understand and easy to grasp, and also the promise of artificial intelligence is really very alluring. So we see a lot of businesses, who are wanting to adopt AI, but it's not truly AI what they are doing. So it's still data analysis or making sense of larger databases, which is actually going one step ahead of just managing data, but it is still not artificial intelligence. So for artificial intelligence, there are some basic tenets, and I mean, you can pick up any book on AI and understand what basically it means and what are the minimum requirements for an AI application to be useful to humanity. But I think there's a lot of progress that has been made in this direction. In fact, one of the things that we were researching on a few months back is, if you look at the listed market companies and look at their quarterly or annual presentations, you nowadays find a lot of mention of things like AI, right? Which essentially, any company, any business that is digitized, any business that has an online presence, definitely by definition has a lot of data available. Now, how you make sense of the data, in what way you make sense of the data, whether you're analyzing the data to just understand what happened in the past, or you're analyzing data to figure out what is likely to occur in the future. I think conceptually these are very two very simple directions that data can be used, to help a business. But to implement that and to really, have takeaways which are implementable immediately by a business is not an easy task. And I think the other challenge that AI has, or any AI engine that I've come across has, is that as the external environment changes, I think the conclusions that one can draw from the same set of data is very different. So AI engines will have to be extremely robust, and I think we all undermine the use of I in that AI. It has to be really intelligent. And I think we as humans are still finding out how to become intelligent. So machines will take far longer.
Absolutely. I think that was a really important point which you made around the dynamism that these algorithms need to be able to have to be able to reinterpret themselves, and as things change, and we see examples of that, in the U.S. markets when algorithms sort of go into these sort of landslide like moments, uh, where you have you know selling triggering more selling, triggering more selling. And in that scenario, the ability to reassess the environment could potentially be critical, which isn't something that we are seeing a lot of yet. So, taking this theme a bit forward in terms of artificial intelligence, India being an IT powerhouse, a lot of the established businesses are already working on artificial intelligence. Do you see that it's still going to be a level playing field for startups?
I think so. Any new technology, so it's kind of give and take. There are pros and there are cons. So, for example, if you have an existing large organization, it's not they're not usually typically very nimble. So any new technology for them to adopt and adapt to is a huge challenge. That's the downside. But I think as a startup, the basic challenge that you have as a startup is that there is no availability of easy capital. So even though you understand your technology, you can build it up and all that, because you don't have infinite amount of capital, you find it very difficult to scale up and really harness the power of the new technology. So I think it's not about whether it's easy for startups or difficult for startups. I think it's as difficult for larger organizations to adapt to newer technologies as it is for startups to really have the capital base or to hire the talent pool that is required to deliver on the promise of that technology. I mean, look at any large bank, let's say State Bank of India, or let's say Axis Bank. These are large banks who have large balance sheets. A few $100 million here or there really doesn't move the needle for them. So they have a lot of money to throw at new technologies. But I don't know any new technology that any either of these banks have adopted ahead of the startup ecosystem. But look at the startup ecosystem. A lot of these new technology companies, look at, for example, payments, right? It's so prevalent today. Everybody uses payment engines. You're using payment platforms, either one or the other. There's so many of them around. But go back 10 years, 15 years when payments were really just starting off. So the startups who were involved in the payment business, let's say 10, 15 years back, it was a huge struggle because they had no money. They had very limited resources to hire the right talent to build, payment gateways and payment systems. But I think today the scenario is very different from that point of view. So I think whether you're a startup or you're a very large scaled up business, it's never easy. There are always challenges, and I think it pays to know where you really stand as a business and play the game accordingly.
Fair point. I think that comparison between banks really brings out, what startups are truly capable of, and we have seen a payments revolution on the back of startups in India. But when you take that same discussion, especially when it comes to capital, and apply it to auto manufacturers, both four wheelers and two wheelers, which relate to your space of electric mobility. Uh, again, how would startups compete there? Because capital advantages are really meaningful, and this isn't like code where you can just sort of put it together. You need manufacturing expertise, you need building expertise, you need large capital base. Things like that become tangible advantages. So, how do startups scope up in a space like that?
Yeah, this is a tough one, you know. So there are enough and more number of startups and new companies that are trying their hand at the EV ecosystem, whether it is by launching the entire EV or it is focusing on the battery part of the ecosystem, whether they are manufacturing batteries or just selling batteries or providing charging stations for batteries. You know, the whole, when you say EV, the whole ecosystem has to come into place. So startups will have to really figure out where they can add far more value. Now, as we discussed, startups by definition don't have access to a lot of capital. And therefore, if they want to become like Ola Electric and set up a whole manufacturing facility, I think it's a pipe dream. But if you're an early stage company, you can, you know, and we meet so many of them on a daily basis. You can do so much in the whole EV ecosystem that and I think you should just if you focus on the press every day, every second day, there's somebody or the other who's a startup that's getting funded in the EV space. So I think it's like look at automobiles, say 100 years back when they just started, and that kind of revolution is happening in the electric vehicle side of the ecosystem. Of course, governments have come forward across the world. They're supporting the EV ecosystem. They're giving, doling out money essentially. They're giving subsidies. They're incentivizing people to set up charging stations. In fact, we just heard that they are making it mandatory for every kind of location to have one charging station, etc. So there's a lot of players who add a lot of small steps to really make it a giant leap. And I think startups in the EV ecosystem as we are seeing, competing very effectively. And that doesn't mean that the larger guys have any handicap or whatever. So, for example, just day before, I was watching this video of, there are two very interesting videos. You should just go to YouTube and see both of them. One was about Tesla's factory in Germany, right? I think outside of Hamburg, and you see the robotics and the automation that they've done in that factory. It's mind blowing. It's unbelievable the level of automation that you see there. Do we have anything comparable to that in India? I mean, very simply, no. I've seen the manufacturing facilities of most auto companies in India, including automated ones, but they are a far cry from the kind of technology that people like Tesla are adopting. The other video that you should go and watch on YouTube is about Mercedes, where one of their EVs just crossed 1,000 kilometers without a charge, without recharging. So for a battery to be able to sustain 1,000 kilometer ride in a vehicle like a Mercedes is really fantastic. So which essentially means that the ecosystem has come a long way from where it was. Larger guys like Mercedes and Tesla have invested billions and billions of dollars in R&D and early rollout of the product. But I think in places like India, the market is not for those kind of vehicles. In India, the EV industry is more geared towards local usage. So you will see a lot of EV two wheelers, a lot of EV three wheelers rather than the EV Teslas and Mercedes in India.
Yeah, makes sense. And I think that's also where a lot of the startups are focusing, around three wheelers and stuff like that. Um, Now, to move on to the more practical aspects of startup investing, what are the different ways in which an individual can invest in a startup? And what is the minimum amount that's required to get started?
A few ways to look at it. I think as an individual, if you are getting introduced to the startup ecosystem and you haven't really, dipped your feet in this yet, my recommendation is, please don't start spending money or investing money and thinking you become an angel investor. There's a very risky asset class because essentially you are backing starting companies that are starting up operation. Even the founders don't know whether their business is going to be successful or not. Nobody knows. So the level of risk that an investor will have to take to back early stage companies is far higher than when you're investing in mature companies or listed companies. So my first recommendation for new investors who want to back startups is that you should do it on somebody else's money rather than your own, which essentially means go join a club which invests into startups. There are a lot of these angel groups nowadays. Mumbai Angels, Indian Angel Network, Let's Venture, Lead Angels. I mean, there are tens and tens of them. Go become a member somewhere and listen to what's happening in the startup ecosystem. Understand what is happening there. See what companies are getting funded, who's investing which company. So there's a lot of background work that one should do before one starts saying, okay, I'm going to put my money there. And I think once you start understanding what the startup ecosystem is all about, that is when you should really start investing your capital. The easier way to invest capital is to invest through any of these angel platforms, or you invest into funds like ours if you're a larger investor, venture capital funds. We also accept money from individual investors. Or the other way to do it is that you start investing in startups directly by yourself, but make sure that you have adequate amount of capital to actually broad base your portfolio. You cannot be putting too much money into just one company and saying, okay, I'm backing startups. So start the journey, make a smaller investment, a token investment, learn the ropes of what startup investing really means. And I think over a period of time, you will then have to put together a portfolio of early stage small companies.
Great point, and I think some really valid insight for beginners who are starting out. When you spoke about larger investors investing in funds like yours, that is the AIF route, right? So, uh, can you explain a little bit more about what AIF means and why you, as a fund, chose it?
Sure. So AIF actually stands for Alternate Investment Funds. This is a regulation that SEBI came out with a few years back, and most VC funds or private equity fund or any fund that dabbles in the unlisted ecosystem has been categorized by SEBI as Category One, Category Two, or Category Three AIFs, and that's essentially how the ecosystem has developed. Uh, we have classified ourselves as a category 2 AIF. There's nothing special about 1, 2, or 3. It's just that what it allows you to do and what it doesn't allow you to do. So as a category 2 AIF, we are registered with SEBI. We have a domestic fund. We have an international fund. And SEBI has laid down very clear guidelines of what is the minimum investment commitment required. How does it work? So I mean, it's a bit complicated for a normal casual conversation like this one, but yeah, it's all there in black and white. So I think SEBI's done a phenomenal job in terms of simplifying regulations that are governing AIFs like us.
Interesting. So you take money from investors and deploy it over a period of 3 years, then hold those investments for another 4 years, and return money back to your investors at the end of 7 years. How are you able to create the liquidity required to return money back to your investors at the end
Yeah,
of 7 years?
yeah. So yeah, that's right. So ours is a 7-year fund, and of these 7 years, we deploy that capital over the first 3 years. And then the next 4 years, we keep working with our companies and take exits as and when they come by. So, for example, in our first fund, we made 14 investments. Of these 14 investments, we've already sold out 4 companies, and we are still in year 4 only. So investors and when we sell companies, we return the money to our investors, which essentially means our investors in Fund One have already got their money back. Part of it. So therefore, as an investor in AIFs, you really don't have to wait till the end of the life cycle of the fund to get any money back. It doesn't work like that. Whenever the fund sells anything, that much money goes back to the investor. So, for example, if we've sold 2 companies this year, that money is gone to investors this year. If we are going to be able to sell another 3 companies next year, that capital that comes from those sales will go back to the investors. So investors keep getting capital back over the next 4 years after the first 3-year investment period. It's not necessarily at the end of 7 years.
Great, great. So I also recently learned, like in the intro I spoke about, that you've been playing a role of an advisor to Marcellus Little Champs. So what is your role over there as an advisor entail, and what are some of the insights you've gathered while being in this role?
Yeah. So again, we are advisors to. We work closely with Marcellus on the Little Champs portfolio. But our involvement is not in the portfolio construction or those aspects of investment management aspects. Our involvement is largely in working with the companies in the portfolio, where we try to play the role of a mentor or a guide to the companies. So, for example, if they've invested in company A, and according to us, when we look at it, company A can benefit by taking steps X, Y, and Z. We will sit down with the management of company A and tell them, listen, I mean, this is great, but if you do X, Y, and Z, your valuation will change like this, market perception will change like this, governance has to be like this. So we'll give all of these. Mentoring and inputs to these companies that are there in the portfolio. And I think it's important when you're dealing with smaller companies to really get involved with these companies, because the upside that you get from smaller companies when they really adopt the best policies available, the best accessibility to intelligence, etc. I think the upside is really very meaningful. So as the name of the fund suggests, it's a of the portfolio suggests, it's Little Champs. So these are smaller companies that we're focusing on, and you'll be surprised. Most of these smaller companies are very receptive to being guided by vested interest. So the fund is invested in the company, and therefore what we are saying is to unlock value not only for us but for everybody who's invested in that company, and for the promoter family itself.
Just to put a little bit more light on the kind of advice that you give, uh, you know what is the level of granularity that advice has? Is it process oriented? Is it management oriented? How deep into the trenches do you actually go?
Yeah. So most of the areas where we get involved with portfolio companies there is largely it's not very micro, right? You can't go down to the shop floor level and say, this process should not be like this, but you make these changes in the shop floor, in the process on the shop floor. That's not the level of granularity that we do. But that said, anything other than that, if we have an opinion on, or if we have best practices that we are aware of, we will share that with the company's management, and then it is for them to really decide whether they want to do this or not. I mean, in some cases, like for example, we've given some inputs on the dividend policy of the company. In another case, we've given some inputs in terms of the hiring policies of a company. What kind of people they should be hiring? How do you attract good talent in non-metro cities or the non-big four metros? And these are real world challenges. All businesses in India are not based only in Bombay, Delhi, Bangalore or Chennai, right? They're everywhere else. And how do those companies really draw and attract great talent? So these are real challenges which we have worked with companies and helped them with, and the results are there to see. The portfolio has done so well.
Absolutely, and I think all of them are lucky to have you as an advisor.
Thank you, thank you.
So, you know, zooming out to the world at large, how do you see the macro environment today?
The macro environment today is so foggy that I think nobody can see anything. there's just there's just so many moving parts and so many changes. There's a laundry list of variables and parameters that are critical and which are very volatile. And that starts with simple things like interest rates, inflation, to wage levels, to employment levels, to geopolitical problems, to supply chain problems. I think there are problems everywhere, and I think the way the global markets have behaved, and the way not only investors but real time businesses have behaved, I think is remarkable. I mean, it's unbelievable that in the face of so much uncertainty, there's still talk of global growth. You go back like say 30, 40 years, 50 years, forget about so many variables up for play. Even if one or two things would change, no, the global growth would find it very difficult to have positive numbers. So I think we are in a very nice place, very very strong position globally. Of course, the challenge is all of those that I mentioned, and I think there are so many more. Those challenges exist. They are real challenges. We will really have to make sure that none of them really take us down. But I think where we are now, as globally, if you look at very macro level, I think there's a solution to all problems, and most of the policymakers really understand those solutions.
Great. So, so I take it that you see, liquidity, interest rates, inflation, things like that, stabilizing over the next 2 to 3 years.
See, I think uh, it's a tough one. I don't have a view on whether they'll become stable or not. And if and stability also is a very relative concept. When you say stable, what do you mean? What kind of range are we now talking about? So I'll not get into those kind of nuances, but generally speaking, inflation, interest rates, and the likes, and the currency movement, etc. I think volatility is here to stay. The faster we learn how to adapt with volatility, the better we will perform in markets. As an investor, if you wait for the volatility to subside before you take any action, I think it'll be too late. So we have to embrace volatility, uncertainty, complexity. All of these are realities for us, and the faster we get our arms around them, the better our portfolio performance will be.
I think that's fantastic. Advice. Um, Two final questions from me, and then we might take like one or two questions from the audience. Guys, in the audience, if you want to ask a question, please DM that question to me. We use this so that we can filter out trolls. Yeah. So my final two questions are around you know you having worked with so many international investors. How do you see how do you think that international investors see India? Are they able to are they recognizing the opportunity that's available in India? Are they able to see it but not so much? uh, that's one. And second, you spoke about uh, coping with volatility. So what would be your advice to investors, both public markets and private markets, as to how to cope with this kind of volatility?
Yeah, I'm so sorry, I missed the question. Can you please, in short, just repeat? I got the volatility one, the first one.
Yeah, the first one was about how international investors are seeing India.
Yeah. So I think international investors, uh, whether and there was a time when a few large international investors understood India, and therefore dabbled in stocks here or assets here. I think that has changed. India is now no longer we have to go and sell India or describe India to global investors. Everybody understands what India is all about. I think India, if you look at it globally, India is one of the fewer markets which is seeing growth, and significant growth. So 7-8%, which we think is low, I think is phenomenal growth if you look at globally what's happening. So I see. I mean, and we talk to investors of all kinds from everywhere, and I think the unanimous opinion is India holds a lot of promise. And this time, with a lot of stability in the country, there's a promise of delivering on that on all of this potential. So we are very very positive on India, and I think most global large investors feel the same.
Your advice to investors on volatility.
See, volatility is here to stay, and investors who, as I said, we have no option but to embrace volatility in whatever way we can. So, and it's not just for investors, by the way. Even if you are just running a business, there's so much volatility now. I just mentioned earlier one of the risks globally is the whole disruption in supply chains. If you're running a business, it is such a big problem if you run out of raw materials. It's just such a big problem if you have everything in place but you can't ship your product, or the price of your end product is very very different than what you anticipated. So I think volatility is part of life, whether you're a businessman, you're or running a business, or if you're investing in those businesses. And as I said, the faster we embrace that and take it in our stride, the better we will be positioned to excel in the current environment.
Great. I think now we can take two or three questions from the audience before we wrap up. Um, we have Espiro. Uh, Espiro, you can go ahead and ask your question. Unmute.
Thank you so much, Krishna ji. Very pleasure, very thankful to Rajesh ji for a beautiful session. Sir, I want to know what is the most repetitive mistakes you find founders doing post investment, and you all have to keep no, correcting it on a recurrent basis.
I, I wish there was just one answer to, to this question. See, I'll tell you, different. Every founder is different, right? And every person has their own way of thinking. So, as a founder, you are really responsible for everything that happens in the business, and which is, I think, a huge responsibility as a founder. As an investor, we bring to the table some value add because we see so many founders struggling with so many different things, and there are so many learnings that we have from different portfolio companies over the years. So I think we look at ourselves as people who can add value to the founder's journey. But if you ask me, if there any single trait or single problem that founders keep repeating all the time, I unfortunately no. Every founder works very differently, and every founder has their own way to heaven or hell.
One more continuing question to this, sir, before Krishna ji takes another question. Sir, post investment, how do you manage to handle stress when you see a high risk or a situation going out of control? Because I've seen investors pointing out to a root cause much earlier than founders accept. That's been my personal experience over the year. You keep telling them 6 months straight, measuring indices and telling them on paper on monthly board meetings. They refuse to accept and acknowledge it, and next year they will say, no, probably you were right types. So which my personal experience has been very opposite on that part.
No, no, absolutely. We've experienced what you just said. It's just not been as repetitive as for me to mention that this is one of the bigger problems, but yeah, it is definitely a problem.
Great. Sheetal, you can unmute and ask your question.
Thanks, Krishna. Thanks, Rajesh. Uh, it's a wonderful session, and I'm happy to joining this over Twitter. I'm usually active on Clubhouse. Twitter Spaces is nothing. Is something which I don't follow much, but uh, for you, I joined today. My question is just as you told that you work as an advisor to the small cap companies for Marcellus, and I feel that as you say that for a smaller companies it is important to get engaged with them after investment. So for a startup, the level of engagement is even higher. So my first question is whether how frequently it happens that you suggest something and the promoter, the founder, they accept your suggestions and follow them, and how frequently they disagree and do something else contrary to your suggestions. Thank you.
Excellent, excellent. I think this is a fantastic question. So this is a real world problem that we have, very regularly in our portfolios. I think it boils down to just one word, and that is credibility. As an investor, we go into a company, we provide them capital and become investors, and this whole relationship starts with a lot of credibility that we bring to the table as our past performance and reputation in the market. But that gets you only so far. As you start interacting with the founders of the company, I think it's our responsibility as investors to build trust and credibility with the founders, so that when we give them any recommendations, they really see the value in it. I can assure you that it is not an overnight process. It takes a long time for that trust to develop between the investor and the founder. So what we've seen is once that threshold is crossed, then I think founders are far more receptive to what you suggest, what you are recommending, etc. But otherwise, what happens is, you are a founder. I come in as an investor, and you will, from your perspective, think that okay, the next day he's trying to boss me around and tell me do this, do that, and and I think that can sometimes go down south. So we have to be very tread this very cautiously and carefully, and build a credibility before we start, giving our suggestions. And it is also, I think, only fair that before we start giving suggestions, first it is our responsibility to understand the business, to understand what the founder is trying to do, to understand the real problems and why those problems exist. And that, again, doesn't happen in a jiffy. It takes time.
Fantastic. Rajesh, the
Uh,
last question. Acha, you have a
Krishna,
follow-up with that?
if you allow me, I have one follow-up question.
Yeah, yeah. Please go ahead.
It looks like that it is not very common for the promoters or the founders to follow what you are advising, or maybe means it is possible that they have bunch of investors and couple of investors are suggesting them in different directions, and it is possible that it is not possible for them to follow the advice of all. So it might be possible that they follow either of them, or they follow none and they follow their own path. So how you take, or how the Marcellus in particular takes, if the company they are invested in doesn't bother to follow what you are advising or they are advising. Thanks.
Again, this is a good question, and you're right. This happens all the time. So, our purpose of investing in these companies is that because we believe that the companies will do very well in the future. And our purpose of giving them advice on that is we believe that with the advice that we are giving, that rosy future will actually be closer than rather than farther. So I think it's a kind of a balance we have to take. Sometimes we may advise the company to move in a certain directions. I think we should also be cognizant as investors that what if that is the wrong direction? I mean, who are we? We are not authorities to say that if we've advised, that is the right advice. So therefore, it comes with a lot of responsibility, and therefore, when we deal with companies, these are all promoters who are mature, mature, who are managing mature companies with a lot of history. So I think you got to respect their learnings and, in fact, learn from them at times. So I don't think it pays to be very fussy about that. I advise them and he's not listening to my advice, so I have to now sell the company. I don't think that's the point of giving advice, or that's the point of building a portfolio. But yeah, to the extent possible, if you believe that they are moving in the right direction and not any disaster is not imminent, I think it's okay. We are okay with that.
Great.
Uh, 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 one last question. I know I am greedy, but the last one.
Rajesh, is that okay
I
with
won't
you?
ask any question.
Yeah, I think we can take this last question. Yes.
Okay, okay.
Thanks. How frequently it happens, or if at all it happens, that the company or the promoter themselves approached you that we are facing such and such problem, and whether you have some solution, some advice for our problem? Thank you.
Sorry, I was on mute. Yeah, yeah. No, it happens very regularly. I think, as I said, it's about credibility. It's about your reputation, what you've built over the years. And today's world is a far more connected world than it was even 10, 20 years ago. So your reputation really, truly precedes you. So there are so many episodes we have where companies reach out themselves saying, "Oh, you know what? We are thinking of these two opportunities. What do you think we should do?" And there's not binding, right? If they're asking us advice, we don't hold them to it that, okay, I advised you that you should do project A, why are you doing project B? I don't think that's how it works. So our advice, our inputs it's one of the input in a bigger framework that the company management has to decide what they should be doing. And listen, I mean, just to wind it up, we are investing in companies and promoters because we have confidence that they know far more than we know about their business. If we start calling the shots, then we should not just be investors. No, we should become promoters and start the business.
Great point. Great point. Rajesh, there's one really good technical question. The speaker's not able to ask it. I think if you allow, we can close with it. It's around how you manage cash levels. As an investor in a volatile environment, you're taking the money in three different tranches. But do you keep cash in case some of your investee companies are going to need additional capital going forward?
No, we never conserve cash. We never keep cash with us. All the cash that we have to deploy is always with our investors, and we call for that cash as and when there is requirement for us to either make new investments or follow-on investments into existing companies.
All right, great. Uh, Thank you so much, Rajesh, for taking out your time and coming here and sharing your valuable insight with us. Guys, please give Rajesh a follow on Twitter. Please, if you are uh, investing in startups or looking at AIF funds, also check out Equanimity Investments. Um, it's been a real pleasure to have Rajesh here sharing his insight. Look forward to having you here again.
No, absolutely. This is very delightful. I think some of the questions were really insightful, and I'm going to be thinking about them a little. So thanks a lot for having me here and allowing me to share my thoughts. I hope it helps the audience in one way or the other. And like Krishna said, do be in touch. You have my Twitter handle, and we'll be more than happy to have you guys follow and follow back.